Welcome to Biz Wire. I'm Joseph Nordstrom in Beijing. After China posted lower than expected GDP growth on Monday, the price of gold fell by nearly 10%, but consumers in China have been flocking to jewelers, some during their lunch breaks, to pocket a bit of bullion while the price is relatively low. Many analysts say weaker than expected industrial and economic growth in China, as the largest gold-consuming country, helped lower prices. Others say that gold futures fell to a two-year low on Wednesday, partly on growing optimism that an economic recovery will curb demand for the protection of wealth. Gold has rallied for 12 years through 2012, advancing as investors sought a store of value before dropping this year. For retailers and refiners, the price plunge is proving a boon for business. The China Gold Association reported that retail sales tripled across China earlier this week as people sought to take advantage of a dip in prices. What some described as a frenzy appeared in India and China, the two biggest gold-consuming nations where gold is often given to celebrate weddings and births. This year's 18% decline could reignite demand that fell last year for the first time in 3 years, with Asian consumers/investors in particular seeing the drop as a buying opportunity. Chow Tai Fook, the world's biggest jewelry retailer by market value, said daily customer traffic in Hong Kong and Macau rose as much as 25% over the past week. Grant Williams, portfolio manager at Vulpes Investment Management in Singapore, said that owning gold is built into the DNA in Asia. Williams says that whenever there are these meaningful sell-offs, there's always a pickup in demand for physical gold. Williams added that it's a very different attitude in places like mainland China, Hong Kong, and India than in the U.S. China is home to about a quarter of global gold consumption, but despite the recent rise in sales, jewelry retailers still face headwinds, including China's slowing growth and Beijing's recent efforts to clamp down on luxury sales, which we've talked about before here in Economic Insight. Jean Li-chun, chairman of the Supervisory Board of China Investment Corporation, or CIC, China's $482 billion sovereign wealth fund, said he believes gold prices will pick up over time as a global economic recovery gains traction. Jean said that gold is still the most important component of the currency reserves of fast-growing emerging market economies. Jean thinks the current decline in gold prices would moderate if the U.S. economy recovered this year and debt distress in the Eurozone economies eased. Jean said CIC has only minor investments in gold and is more looking to invest in European companies where there is access to high-level technologies. CIC, which manages a slice of China's foreign exchange reserves, the world's largest at $3.44 trillion, still has some cash at its disposal from its last government injection of cash in 2011. The collapse in bullion prices may help to rekindle gold mining takeovers as Chinese companies, sovereign wealth funds, as well as private equity and hedge funds step in to rescue cash-strapped small and mid-sized miners. China's top gold producer, Zijin Mining, and state-owned Shandong Gold Group have been leading the expansion push. China produced 403 metric tons of gold in 2012, up 11.7% from 2011, leaving the country as the world's top gold producer for the 6th year in a row. Wang Yang, fund investment analyst at Galaxy Securities in China, explained that the rise and fall of gold prices depend to a large extent on how willingly people want to hold the metal. Wang said that it is unlikely that investor confidence will recover in the short term, but in the long run, because the price of gold is inversely related to real interest rates, the opportunity cost of investing in gold will fall as the inflation-adjusted return on other types of investments, such as bonds, decrease. Wang believes this is particularly the case with central banks around the globe pursuing quantitative easing policies to stimulate the economy. The typically safe haven asset has failed to rise on tensions in the Korean peninsula and has been hit by uncertainty over the U.S. Federal Reserve's stimulus program. Besides these, other factors behind the fall in price is countries unloading some of their reserves. Besides Cyprus selling some of its reserves to deal with its debt crisis, there is also a possibility that other beleaguered countries, including Italy, which has abundant gold reserves, might follow suit. Credit Suisse downgraded their 3-month outlook to negative and expect prices of $1,300 in 3 months. A dramatic fall in the price of gold has caught many investors by surprise and raised questions over whether a bullish market that had seen prices climb for 12 straight years has finally ended or is merely a good buying opportunity. This is Biz Wire on the Blue Ocean Network. Stay tuned for more in Economic Insight.